Hello YouTube, welcome to my channel. Today we're going to be talking about the company Steel Dynamics, ticker STLD, and I'm going to be giving you some stats and some information to help you make a better decision as to if this should be part of your portfolio or not. So, Steel Dynamics is an American-based company. They are out of Fort Wayne, Indiana. And from my eyes, they have a pretty great diversity of product and a seemingly proven ability to scale and adapt with demand needs. So on the screen, I have a rough breakdown of their business. You can see 3/4 of their business comes straight from steel, the 6 steel mills and 11 sheet steel coating lines that they have. They do, however, have 1 liquid iron production facility, and you can see recycling and fabrication make up the rest of their business. So respectively, a good diversity of product and ability to help customers in a variety of different ways. Over the span of time, here's a graph showing from 1996 all the way up through more present times. This is a chart on their latest quarterly review as of August 7th, 2017. And you can see they were doing $250 million when they first came into production, and they were doing roughly 1.4 million tons of steel. Now their capacity as of 2014 is 11 million and actually higher. And you can see just on the screen all the different acquisitions and expansions and increases in capability that they've had. So as revenues have increased, and even as revenues corrected in 2008 and 2009, you can see Steel Dynamics has done a great job of upping their actual capacity as well as stabilizing their profits. And actually more encouraging is the fact that in the last 6 quarters they have, as we saw, relatively stable production, but their average sale price on that production has went up quite well actually. This time last year they were selling at $100 lower average sale price. So pretty drastic there. It's about a 13% jump. When I correlate that against their stock price, their stock has stayed relatively stagnant, if not slightly dipping, over the last 9 months to a year. And so maybe it hasn't quite caught up with their ability to make more money on what they're producing. Here's some of the ratios we like to look at. Market average for PE, 23.6. Steel Dynamics falls well below that at just a 15.6. Earnings growth looking forward, 0.5. That is an excellent earnings growth to price ratio. And then price to book actually ekes in a little bit lower than market average as well. So really everywhere that we look across this spectrum, we're seeing a lot of positive ratios, a lot of excellent technical indicators. When we talk about revenues, again, remember we had pointed out 2008, 2009. They also had a little bit of dip from 2014 and then down into 2016. It came back up coming out of 2016. And if you remember back to the chart we looked at acquisitions and expansion, they did a decent amount of acquisition in 2014 and 15 respectively. So hopefully coming out of that now, not only will they increase revenues, but you can see the profitability starting to eke up there as well. Looking at that profitability against debt, well, there we see those acquisitions and where that money went to. And just on surface value, this maybe isn't that encouraging to look at, but the debts have steadily dropped since mid-2014. And though higher than ideal, management has shown a strong ability to cover these debts comfortably and control earlier bleeding. In fact, if I were to maybe double down a little bit more into that, let's just look at what the timeline of that debt looks like. It's a lot of long-term debt spread out over 2021 to 2026. Absolutely long time span that we're looking at here. And considering the profitability was going up, and they've covered a lot of their bases with expansion, I think it's reasonable to say that they'll cover those debts. Some of the reasons I feel positive about saying that, well, here's their market cap and their operating margin, respectively, left to right. Market cap versus competition, they're well above the other players in their market. And then when we look at operating margin against that same competition, they're at the top, if not the very best. So when you're the biggest and the best at making money, it's really hard to make ground on that type of company. So ultimately what I'm saying is as the steel industry goes, Steel Dynamics will go. Here's a couple references to some of the things we looked at earlier. Operating income per ton shipped far exceeded their peer group average, and this can partially be attributed to Steel Dynamics' focus on providing higher volumes of galvanized, diversified products. And this increases profitability and transitions away from older product offerings. So on the right, we can see their product mix, and over 50% of their product mix is what they internally refer to as value-added products, which is exactly what it sounds like, products they're making more margin on. Their capacity, we looked at it a little bit earlier. Here's that same capacity with their shipments in there as well, and then it's correlated there against a forecast of U.S. steel going forward. So you can see as a country where steel has been, where it's likely to go according to analysts, and where Steel Dynamics has been during that. So pretty strong correlation there. One of the most exciting things I found when researching this company was their performance-based incentive compensation. Over 85% of senior management compensation is at risk, 60% respectively for employees. What does this mean? This means that everybody in this company has some skin in the game, and that everybody is working towards the same goals of accountability and consistency. In fact, when I looked this up, there were over 10 million shares owned by insiders in this company. So top management really has some skin in the game, which is always important when we're looking at management. So all of these things combined, here's intrinsic values, their future cash flow value versus their current share price. And you can see there's a pretty big discrepancy here. In fact, there's about a 24% overlay from what the future cash flow shows and what the current share price is. So a decent amount of wiggle room there indicates that there might be some future growth ahead in this stock. And last but not least, of course, we have to talk about dividends. Dividends for this company comes in at 1.86, if I remember correctly. It's estimated to say relatively stable going forward, and that only represents about 26% of their current net profit. So they can comfortably afford to pay us that dividend. And actually looking forward, because of the growth we've talked about, and because the dividend will stay stable, it's likely that that payout ratio will just shrink. So all this means is that they can comfortably afford to pay us that 1.8 and likely even raise that dividend, considering they're pretty far below the top payers in the steel industry. Okay, so as always, what exactly is the catch? Despite a strong position in the steel industry, Steel Dynamics is ultimately able to grow only really as fast as the industry itself. If we see steel stagnate across the United States, well, that's really going to hurt this company more than anyone else, considering their market share. Diversifying their product base has broadened their horizons in many ways, but potentially opened them up to competitors outperforming in specific niche markets. So I don't really have a great reference for this, and really I'm just talking hypothetically. But in general, if you're a jack of all trades, you tend to be a master of less things. So we'll keep an eye on that going forward. And the last big catch for me was that the dividends, though safe and reliable, are half of what some of their competitors are paying in the same sector. So we saw that the company was focused on expansion, acquisition, and hopefully this will continue to push the value of the stock up and compensate for the weak dividend. But I'd like to also think that maybe this will allow them to start pumping into that dividend as well, and maybe reward us for staying around with them, considering they've been a little stagnant this year. So all in all, a recap of Steel Dynamics: great PE ratio, 15.6 compared to the rest of the steel industry, which came in at a 23.6. Future cash flows show the stock at roughly 24% undervalued. dividend of 1.83%, there it was, gave us a payout ratio of 26% respectively. And this continues to shrink as the company continues to grow. Excellent incentive-based payouts across the entire company, but especially in upper management, gave us a lot of skin in the game across the entire corporation and gave me a little bit easier of an ability to jump into this company. And lastly, the diversity of their product. We talked about this maybe being a two-sided sword, but I really think it's important from the perspective that it's allowed them to make more profit on a relatively stagnant output. So with all that said, that is my overview of Steel Dynamics. I please encourage you to ask any questions, anything that you might want to see reviewed in the future, just throw it down there in the comments section. I am a small pond. There are very few fish here, so the more that engaged you are as a viewer, the more I know what to actually feed you guys content-wise. So with that said, please subscribe. It would make my day, maybe even my week. And of course, I'd love a like as well. Thank you guys so much for your time. Have a great afternoon.